Now, so far what we have discussed is what is the importance of monetary policy tools and using the different tools within the monetary policy or instruments of credit control. RBI will either increase the money supply or decrease the money supply. But please understand this, RBI or the Monetary Policy Committee, when do they increase the money supply? What is the impact of that? How this will lead to creation of a credit in the system? And to understand that, we need to understand the concept of money supply and monetary aggregates. Whenever RBI changes the monetary policy, or let's say decreases CRR, increases SLR, reduces a repo, reverse repo, etc., that will definitely have an impact on how much money is created in terms of credit, right? In terms of loans in the market. And how does the monetary policy decide, okay, this is sufficient, right? This particular amount of supply of money sufficient, let's withdraw it, or let's supply much more in the system. How does the Monetary Policy Committee decide that? To understand all of this, you need to understand the basic idea of a monetary aggregates. And please understand this. In order to understand these particular monetary aggregates, first you need to understand the concept of fractional reserve system. Okay, fractional reserve system. Earlier I had used this particular terminology of fractional reserve system in the types of money. Let's try and understand this under the context of monetary aggregates. Now, generally what happens is RBI will print the currency notes and will issue these particular currency notes, supply these particular currency notes in the system. Okay, issue or supply the currency notes in the system. And whenever the currency notes are supplied, essentially it means what? Money supply is taking place in the economy. Increased money supply could lead to reduced interest rates, right? Increased credit supply in the market, more and more companies taking loans, right? Producing more, right? And employing more, GDP growth rate will increase, the cycle will continue. And on the other hand, if RBI takes out certain amount of money supply from the market, increases the interest rates in the market, that will essentially lead to lower money supply and lending at a higher rate of interest. That will lead to what? Loans being issued at a higher rate of interest, lesser loans will be taken, investment will come down, and this will basically limit the production, limit the growth, but more importantly, control inflation. So how does RBI decide? How does the Monetary Policy Committee decide when to increase or when to decrease the money supply? Now have a look at this. RBI prints the currency note, issues it in the market, and essentially means what? The money, right, has entered into a system, supply of money has increased. And what is the impact of this? How does this particular, let's say hypothetically, 10 rupee, right, or let's say 100 rupee has been issued. What is the impact of this? Let's assume there's a person XYZ, okay, he has received this particular 100 rupee. I can understand this. The person XYZ has received this particular 100 rupee. Now, let's say this particular person XYZ will approach bank 1, okay, or bank A. He will approach bank A, deposit this particular 100 rupee in this particular bank. Is it okay? Deposit this particular 100 rupee in the bank A. Now, please understand this. Bank A cannot use all the 100 rupees and issue loans in the market because there are reserve requirements. We have discussed this already. There are reserve requirements, and just for sake of simplicity, let's assume reserve requirements are 10%. So this essentially means out of 100 rupee deposit that has been received by bank A, it has to keep aside 10 rupee, and remaining 90 rupees it can issue in the form of a loan. Now let's say this particular 90 rupees loan is received by a businessman ABC, right? An industrialist or a manufacturer ABC has taken a loan of 90 rupees. What does he do with this particular 90 rupees? He will take the 90 rupees, purchase a machine from the market, purchase raw material from the market, and essentially he is going to spend on the market. Let's say he will purchase right 90 rupees worth of a machine from the market. Again, don't ask me, sir, which machine is available worth 90 rupees. That is not important. Let's say this particular businessman or manufacturer ABC has taken a loan of 90 and he purchases a machine. Right? Imagine I'm the businessman and you are the seller. I will purchase the machine worth 90 rupees and I will give you a check of let's say 90 rupees or I give you 90 rupees cash. Now what will you do with this particular 90 rupees? You will also take this 90 rupees, go to bank B or second bank, deposit this particular 90 rupees. So have a look at this. In the first step, this is a step 1. In the first step, 100 rupee which was printed and issued by RBI, this particular 100 rupee has gone into bank A and a loan of 90 rupees has been issued in the market. Now this particular 90 rupee in the second step has been given to a seller or a vendor in the market, and this 90 rupees has gone into second bank or bank B. Is it bank B always? Not necessarily. You can deposit the money in the same bank, that is bank A only. Just to make the process simpler, I have taken this as a second bank. So what will the bank B do with this particular 90 rupees now? The bank B has to maintain certain reserve requirement, 10%. So it has to keep aside 9 rupee. Now out of the remaining, that is let's say 81 rupee, let's say the bank will issue the 81 rupee as a loan to a home buyer. Now this is a third step. In case of third step, there is a home buyer who has taken this particular loan of 81 rupee. He will go to the market, purchase a home and give this particular 81 rupees to the real estate developer. And the real estate developer will collect this particular 81 rupee, deposit this 81 rupee in bank C. Now the bank C has received 81 rupee. Now out of this 81 rupee, it has to keep aside 8.1 rupee because that is a statutory requirement or a reserve requirement. And remaining 72.9 rupees, it will basically issue it in the form of a loan, let's say to another manufacturer in the market. But understand the logic here. From one step to next step, banks are keeping certain margin requirements and remaining amount they are lending in the market. So credit or the loans are getting created in the system. That is one point you need to make a note of here. Second important point, the money supply in the market. Right? Understand this. The money supply in the first step was how much? That is RBI printed only 100 rupee and issued that in the market. Okay, RBI has printed how much? Only 100 rupee and it has issued that in the market. The same 100 rupee is shifted from one bank to another bank after deducting the margin requirements like this. Remaining amount gets transferred from one bank to another bank. And so please understand this. Money is not getting printed. Okay, understand? Money is not getting printed. For example, in the second step, Bank B is not printing 81 rupees. Bank B has received money from Bank A, which they are using it to issue loans. Bank C is not printing 72.9 rupees. Bank C has received money from Bank B and they are issuing this particular money after keeping certain amount of reserves on the side like this. So at every step, because there is a banking sector here, at every step, the credit gets created, loans get created. And this particular concept is called as money multiplier. Is it okay? This is referred to as money multiplier system. Right? And why there's a money multiplier system at place here? Because the banks are receiving money and they are lending after keeping certain amount of reserves. And this particular process, understand this particular process of creating loans, creating credit is basically the idea of a money multiplier. RBI has printed only 100 rupee, but because this 100 rupee has been supplied to the bank, the 100 rupee is shifting from one bank to another bank minus the reserves. Right? This is being used to create credit in the system by the banking sector, and this is a money multiplier concept. Done? And the second idea here is, what do you mean by fractional reserve system? Fractional reserve essentially refers to the practice of the banking sector to maintain a certain amount of reserves. Is it okay? To maintain certain amount of reserves, this is a mandate of RBI. RBI says you can issue loans in the market. I don't have any issues. Collect deposits, give loans in the market. But all the deposits, you are not allowed to give loans. You are not allowed to use all the deposits to give loans. You will have to maintain certain reserves. And this particular system is called as fractional reserve system. And in case of India, just like banks around the world, the fractional reserve system is used to create credit, to create a money multiplier in the system. And this particular process is going to continue. Is it okay? This particular process is going to continue Again from bank C to bank D, 72.9 rupees will come. Out of this, 10% will be kept aside. Remaining amount will be issued in the form of a loan. This is called as a money multiplier. Done? Now, using this, we'll be discussing the concept of the overall money supply in the market or monetary aggregates. And there are 5 monetary aggregates here: M0, M1, M2, M3, M4. These are the 5 monetary aggregates. And for UPSC exam, so please be very, very careful with respect to M0, M1 and M3. Why? We'll come to this. But let's start here. M0 basically referred to as high powered money. Okay, M0 is referred to as high powered money, or else this is also referred to as a base money. And what is the M0 representing? M0 represents the liability of RBI. Is it okay? M0 represents the liability of RBI. Right? And the liability of RBI essentially means what? The money that has been printed and distributed by RBI. Right? I am using the term money. It could be referring to the currency notes as well as the currency coins here. Okay? So the money that is being distributed in the system, plus if there are any deposits that are there with RBI, they will also be considered as a part of high-powered money or base money. And understand this, whenever the high-powered money increases, whenever the base money increases, it essentially means because of the fractional reserve system, the total amount of money that is supplied in the system, the money that is created in essence through credit system is also going to increase. For example, in the earlier system or earlier example that we had taken, right, that is RBI had printed 100 rupees. This particular 100 rupees that was printed and issued by RBI is the liability of RBI. Is it okay? It is the liability of RBI. Now some of you simply ask, sir, how 100 rupees printed by RBI becomes a liability for RBI? Right? To understand this, you will have to know the accounting concept. Now for example, I am RBI, I have printed 100 rupee note. Do I simply issue it in the market? Right? Do you think RBI office is there? You can simply go collect 100 rupees from RBI? No, that is not how RBI supplies money in the system. Let's take an example here. I am RBI, you are the banking sector. You are one of the banks. If I printed 100 rupees, I will give this 100 rupee to you. Right? It is an asset. I will give 100 rupee to you, and in return, I will take something from you. Have you understand this? RBI doesn't simply print currency and give it to everyone in the system. That is not how the banking works. RBI prints currencies, and to supply the currencies, these particular currency notes in the system, it will on one hand, from one hand give the currency notes to the bank, and on the other hand will collect some assets from the bank. So have a look at this. You are a bank, 100 rupees given by RBI to you, and in return RBI collects, let's say, G security worth 100 rupee. Is it okay? G security worth 100 rupee, which essentially means what? This G security is an asset for RBI. Is it okay? G security is an asset. So that G security is collected, G security becomes an asset, and the 100 rupee that is given by RBI to bank becomes a liability. Done? So any currency note that has been printed and issued by RBI, right, the currency notes or coins like this becomes right, a part of currency in circulation. And because these right, are issued by RBI, they become liability of RBI. Done? So this is the first concept, M0, currency in circulation, plus any deposits that are held by RBI are also part of M0. It is also referred as a high powered money or base money. And whenever high powered money or base money increases, M0 increases, you can also expect that the amount of a credit creation in the system will also increase, because right, the money in circulation or currency in circulation earlier was how much? Example 100. Now imagine RBI prints another 100 rupee currency note, issues that into the market. So this base money has increased. There's a fractional reserve system. Money multiplier will take place. So as a result of this, credit creation will take place in the system. Right? So M0 increases, you can expect total money in circulation, credit creation in the circulation to also increase. Now second, M1. M1 is referred as a narrow money. Remember this, right? M1 is referred to as narrow money. Okay, M0, high powered money, base money, or else there is also one more term, monetary base. Remember this also, monetary base, right? M0 is referred with a different name, so do not get confused. Now, what is M1? It is referred to as narrow money. What do you mean by narrow money? To understand this, there is a term called as liquidity. Understand the term liquidity first, then we'll look at narrow money. Liquidity in this particular context is a feature of an asset. Okay, liquidity is a feature of an asset, and it basically represents how quickly the asset can be converted into money in the market. I will repeat it. Liquidity is a feature of an asset, and it represents how quickly you can convert this particular asset into money in the market. For example, on one hand, you will have cash. In the other hand, you will have a bank deposit. Between these two, which has a very high liquidity? Obviously cash, because the cash needs no conversion. It is already in the form of money itself. And please understand, bank deposits are asset for the holder. That is a customer. Cash is an asset for me. Gold is an asset for me. Property is an asset for me. Is it okay for the owners? These are all the assets. So when you have 100 rupee cash in hand, and let's say land, property documents in the other hand worth 100 rupee. Both are same 100 rupee, but please understand, cash is already in the form of money. There is no need for converting this. But on the other hand, you have a property document worth 100 rupee, right? It is not equal to 100 rupee. You can sell it in the market, and only then you will have 100 rupee cash in your hand. Is it okay? So in terms of the liquidity, what does it mean? It simply refers to a property of an asset, as to how quickly you can convert this particular asset into money terms with the lowest loss of value. And please understand this, you have let's say cash in your hand, you have a savings bank deposits. These are having very high liquidity. Is it okay? I'll repeat it. When you have cash in your hand, when you have a savings bank deposits, you will have a very high liquidity associated with this. On the other hand, imagine you have time deposits. Is it okay? In case of high liquidity, example is cash. Example is savings deposits or a demand deposits. In case of a time deposits, liquidity is much lower. What do you mean by this? I've kept 100 rupee in a savings bank account. I can withdraw it at any given point of time. I can go to a bank, withdraw it. I can go to an ATM, withdraw it. Or else I don't have to go to bank. I can issue a check, right, worth 100 rupees to somebody in the market. And so demand whenever arises, I can withdraw this particular amount. Hence the liquidity will be very high. What about the time deposits? For a certain specific period of time, the money is kept with the bank. Let's say 90 days, 91 days, 181 day, right, or 365 days. So the liquidity in case of time deposits are comparatively low. Is it okay? Time deposits carry lower liquidity. Demand deposits carry much higher liquidity. Cash has the highest liquidity in the market. Then, now when I talk about M1, in the market, the money can be present in the form of a demand deposit. Money can be present in the form of a time deposit. Money can also be in the form of cash. But for example, have a look at this. RBI has printed, let's say hypothetically, 100 rupee cash or 100 rupee notes have been printed. Now I have this 100 rupee. What I'll do is 50 rupees out of this, I will keep it in the form of cash. I will keep this 50 rupees with me, and remaining 50 rupees I will deposit in a bank. And again, when I deposit this particular 50 rupees in the bank, there are two options available to me. I can keep this particular 50 rupees in the form of savings bank account, or I can keep it in the form of let's say fixed deposit. Or out of 50, I can again split it. Right? 30 rupees I'll keep it in the form of savings bank, and 20 rupees I'll keep it in a fixed deposit. So the different combinations are available. You don't have to worry about that. But the idea here is this 100 rupee, which is a liability for RBI, 50 rupees is in the form of a cash with the public. I'm part of the public, so 50 rupees is there with me. Remaining 50 rupees, imagine this, I've kept it in the form of a demand deposit. Okay, a savings bank account. So now, right, out of the total 100 rupee which has been printed and issued by RBI, as a result of this, money is getting created in the market. But out of this, how much has very high liquidity? I repeat, 100 rupee printed and issued by RBI in the market. This gets circulated in the system either through bank deposits, that is a demand deposits, right, EFTs, etc. So money gets created. But out of this particular money, how much has very high liquidity? That is the concept of narrow money. Is okay? Narrow money essentially means we are having a narrow viewpoint. We are looking at only that particular amount of money in the system which has very high liquidity. Now if I ask you between cash, right, demand deposits and time deposits, which of these has very high liquidity? Cash has very, very high liquidity. Demand deposits have very high liquidity. Time deposits have very low liquidity. When I talk about narrow money, I'll be considering how much is the currency held by public, that is 50 rupee held by me, and remaining 50 rupees, let's say I put it in a bank in the form of a demand deposit. As a result of that, it gets circulated. Again, deposits are created. Right? Out of total deposits, how many are demand deposits? How many are demand deposits in the banking sector? That will also be considered. Okay, so cash held by the public, currency held by the public, demand deposits which are created in the banking sector, and finally, any deposits which are held by RBI, right, will also be considered. So M1 is called as a narrow money. Then let me go to M2. In case of M2, just take M1 as usual, right? Just consider M1, and to the M1 you add a post office savings deposits. And please understand, RBI says over a period of time the importance of post office deposits has kept on declining, because earlier in 1960s, 70s, 80s, especially 90s, these particular post office deposits were very prevalent. Right? The idea of post office deposits were originated because the government of India wanted to ensure that the low income households, right, medium income households will be saving certain amount of money and they'll be investing in the postal deposits. Right? With that objective of mobilizing savings from lower income households or medium income households, we introduced post office savings deposits. But over a period of time, how much money is saved by the households in the form of post office savings deposits has kept on declining. And that is a precise reason RBI doesn't give too much of importance or weightage to the concept of post office savings deposits. So we will consider M1 as usual, and how much money is there in the post office in the form of a savings deposits will also be considered, and we'll call this as M2. And there is no name for M2, do not worry about it. Let's go to the next one, most important one, M3. M3 is referred to as broad money. Okay, M3 is referred to as broad money. Why it is referred as a broad money? As usual, how much is a narrow money we will consider. Okay, as usual, how much is a narrow money we will consider that, M1. In addition to M1, as a result of money circulation, as a result of fractional reserve system in the banking sector, how much is the total time deposits in the banking sector will also be considered. Is it okay? How much is the total time deposits with the banking sector will also be considered within this particular concept of, right, M3. Right? That is the reason we are considering narrow money as well as the money which has a lower, comparatively lower liquidity. This is referred as a broad money. Broad money essentially means we are considering larger amount of money supply in the market compared to narrow money. In narrow money, we focused only on that amount of money supply which has a very high liquidity. But under M3, yes, that money supply which has very high liquidity plus that amount of money supply which comparatively has a lesser amount of liquidity. Example, the time deposits, right? Hence M3 is called as a broad money, right? And finally M4, right, which as usual will take M3 into this and at the postal deposits, a post office savings deposit. Then that will give you M4, right? And there is no name for M4, do not worry about it. Now, what is the importance of this for UPSC, right? Understand this. Basically, the idea here is RBI or Monetary Policy Committee, when they want to decide how much should be the money supply, should we increase it, should we decrease it, they'll be focused on M0, they'll be focused on M3. Is it okay? They'll be focused on M0 as well as M3. What is the connection between both of them? We arrive at M3 because there is M0. Is the logic okay here? We are arriving at M3 because there is M0. Because RBI is printing currency and issuing it in the market, right? The money is getting circulated because of fractional reserve system. It is leading to money multiplier effect. Huge amount of credit is created in the system, and that is essentially measured in the form of M3 because money gets circulated. Right? When money gets circulated, obviously the demand deposits in the banking sector will increase. Time deposits in the banking sector are going to increase, and that will give you the idea of a total money that gets created because RBI is printing currencies and issuing it in the market. And that is a precise reason under the concept of a money multiplier, you will have to remember this. The formulas that are used, right? Have a look at this. Money multiplier is equal to M3 upon M0. Okay, M3 upon M0. What does it represent? Imagine RBI has printed 100 rupee and issued it in the market. And as a result of a money multiplier system or a fractional reserve system, the total amount of a credit that is created in the system comes out to be around 1,000 rupees. And this is what I'm referring to. Right? Loan of 90 rupees here, loan of 81 here, loan of 73, around 73, and subsequently the steps are going to continue. So when I get the sum total credit created, let's assume is 1,000 rupees. So this is what I'm considering here. Okay, total money supply in the market is, let's say, 1,000 rupees, but RBI printed only 100 rupees. Right? RBI printed only 100, but because it is getting circulated like this, total money circulation comes to be 1,000 rupees. So money multiplier comes out to be 10 times. Okay, money multiplier is 10 times, which essentially means if RBI prints or RBI increases the money supply, let's say by 100 rupee, as a result of fractional reserve system, the total money circulation in the market will be 10 times the money supply. If RBI issues 100 into 10. If RBI prints 200 rupee, issues it in the market, 200 into 10. If RBI asks the banks, reduces let's say CRR, repo rate, etc., as a result of which new money supply comes to the system into 10 times will be the total money circulation. And that is the reason money multiplier becomes very, very important. So Monetary Policy Committee or MPC, before they decide whether to increase the money supply, decrease the money supply, they will definitely consider what is the money multiplier right now. I've given you money multiplier is equal to M3 upon M0. Some of the books will also give you M1 upon M0. But please understand, M1 is a narrow money. Is it okay? M1 is a narrow money. But apart from narrow money, there is also, right, a broad money. And that is the reason M3 upon M0 will give you better money multiplier. Here it is also money multiplier. But I'm considering only small amount of money supply in the market by considering a narrow focus here. That is the money which has very high liquidity. But apart from that, there is also money with lesser liquidity. That is the reason M3 upon M0 will be a better measurement of money multiplier. And some of the other books will also give you money multiplier. I'll use a short form here. MM is equal to 1 upon reserve ratio or reserve requirements. Right? What do you mean by reserve requirements? If you remember the earlier calculation that we have done, there are reserve requirements for the banking sector as mandated by RBI. What was my assumption here? Assume reserve requirement is 10%. Right? And the money multiplier can be calculated like this also. 1 upon 10%. And 10% can be written like this, 1 upon 10 divided by 100. The denominator of a denominator becomes a numerator. That will be 100 divided by 10. Cancel 0, 0. And you will be left out with 10 times. So money multiplier can also be calculated like this. Okay, so money multiplier essentially will give you an idea as to if RBI issues another 100 rupees, pushes 100 rupees into market, totally, right, as a result of fractional reserve system, totally how much money gets created in the system. Right, that is the importance of studying the monetary aggregates as well as a money multiplier here. And apart from this, right, suddenly there could be a question even in case of liquidity also, considering the money multipliers. That is, they will ask you which of the following has the highest liquidity. Now, between M1, M2, M3 and M4, remember this, M1, M2, M3 and M4, M1 will have the highest liquidity. Is it okay? M1 has the highest liquidity and the liquidity will keep on decreasing like this. Done? So, these are some of the points with respect to the monetary policy of RBI. Next, other functions of RBI. I can understand this. What we are discussing is the functions of RBI. Right? So, other functions of RBI, it is also referred to as a banker to banks, bank of last resort. Remember this. Bank of last resort, regulator of a banking system, etc. Why? Banks, whenever they require money, they can approach RBI and take loans from RBI. Is it okay? The banks can approach RBI and take loans. And for example, there's a bank rate. Right? So, under this particular system, the banks can borrow from RBI. Different tools are there. We have discussed this already. They are allowed to take loans right from RBI. But please understand this. Here itself, I will introduce one more concept. Let's say a bank is there. They want to borrow from RBI. Are there any limits on it? Can they borrow any amount of money, let's say under bank rate? Can they borrow any amount of money, let's say under repo rate? RBI doesn't allow this. Is it okay? RBI doesn't allow this. There is no unrestricted borrowing from RBI. RBI generally imposes certain restrictions, certain limits as to how much the banks are allowed to borrow from RBI. Now, what will happen is, imagine, right, a bank can borrow from the RBI under repo window. They can borrow from RBI under repo system. But what if the limit that is imposed by RBI, the bank has already exceeded the limit or it has already hit the limit. But now it wants to borrow more from RBI. Right? So in this particular situation, understand this, RBI has introduced a system called as the liquidity adjustment facility. Okay? Liquidity adjustment facility. In short, it will be referred to as LAF. Okay, liquidity adjustment facility. And liquidity adjustment facility refers to the tools which are used by RBI to adjust liquidity within the banking sector. I stated that under repo window, the bank can borrow from RBI. Short duration, they can borrow, definitely yes. But what if the limit that has been imposed by RBI has already been reached by this particular bank? RBI says you are allowed to borrow, let's say, 1% of your NDTL under repo, and the banks have met this particular limit. right? Now banks want to borrow more, but can they borrow under repo? Not allowed. And for this reason, under liquidity adjustment facility, RBI has tools such as repo, marginal standing facility, MSF, marginal standing facility. Now, what is this marginal standing facility? Look at this. Under marginal standing facility, under MSF, banks can borrow for a very short duration. Is it okay? Banks are allowed to borrow for very, very short duration, generally for overnight purposes from RBI. Is it okay? To adjust their liquidity requirements. RBI has imposed certain liquidity requirements or liquidity guidelines or norms on the banking sector. Banks have to meet this particular norm or the guideline. If they have already exhausted their limit under repo, now they are not allowed to borrow for a shorter duration under repo. So now they can use another tool of RBI, marginal standing facility, MSF, marginal standing facility, and borrow from RBI under this particular MSF. But there are conditions here. Even under MSF, RBI will impose certain limits. RBI doesn't allow the bank to borrow any amount of money even under MSF. Okay? So limits are imposed. First thing. Second thing, it is used for very, very short duration, usually for overnight borrowing. Third thing, whenever a bank borrows from RBI, under the marginal standing facility, RBI charges a higher rate of interest. Okay, higher rate of interest. And generally the rate of interest under the concept of MSF is a link to repo rate. Is it okay? It is a link to repo rate. What do you mean by this? Imagine repo rate is 5%. RBI will basically say marginal standing facility is equal to repo rate plus let's say 0.25%, which essentially means right now if the repo rate is 5% and you borrow from RBI under MSF, the rate of interest applicable will be 5.25%. If the repo rate is reduced from 5% to 4% and now you borrow from RBI under MSF, then the rate of interest charged on the MSF will be 4% plus 0.25, 4.25%. So generally understand this, what RBI does is, it will link MSF rates to repo, it will link reverse repo rate to repo, it will link bank rate to repo. And you need to remember this, the bank rate, MSF rate are higher than repo rate. Is it okay? The bank rate, MSF rate are higher than repo rate. Reverse repo rate is lower than repo rate. Is it okay? Reverse repo rate is lower than repo rate. And generally when the repo rate is adjusted, when repo rate is announced by RBI or Monetary Policy Committee, it is changed, either increased or decreased. Automatically the MSF rate will become adjusted, reverse repo rate is adjusted, and bank rate is also adjusted. Right? So that is the reason, again and again I am telling you this, repo rate is the most important policy rate used by RBI today. Okay, it is the policy rate. And most of the other rates are linked to this particular policy rate. And when the policy rate, that is interest rate of RBI through repo is changed, then automatically these interest rates will also get adjusted. Done? So one, under the concept of the banker to banks, the banks are allowed to borrow from RBI, but all the borrowing cannot happen under the repo or bank rate. RBI imposes certain limits, and that is the reason RBI has introduced a system called as Liquidity Adjustment Facility, LAF, wherein banks can borrow up to certain limit from RBI for a very, very short duration, overnight purposes. But most importantly, if you use the marginal standing facility, you will have to pay a higher interest rate to RBI. That is one very important point you will have to remember. Second, RBI is the regulator of the banking sector in India. Is okay? RBI is the regulator, which essentially means anybody wants to provide banking services, anybody wants to operate a bank, they will have to get the license from RBI. RBI will decide how many branches in urban India, how many branches in rural India. RBI will decide what kind of assets you are supposed to hold, in what kind of assets you are supposed to invest, how many ATMs you are supposed to open in different regions, and what kind of loans you are supposed to provide to borrowers in the market. These kinds of regulatory activities are conducted by RBI. You want to merge banks, RBI is there. You want to close the bank, RBI is there. That is the precise reason RBI right, is also a regulator of a banking sector in India. Yeah. Done. Next one. It manages the forex reserves. RBI manages the forex reserves. Now, what are the important points here? Let's start with the basics here. What do you mean by forex? Forex basically stands for foreign exchange reserves. Okay? Foreign exchange reserves. This is the first point. And what is the importance of foreign exchange reserves? India is an open economy. Okay, under Industrial Policy Resolution of 1948 or Industrial Policy of 1948, we basically stated that we will follow a concept of a mixed economy and India is an open economy. What do you mean by open economy? Imports are allowed, exports are promoted, right? India has trade relations with other countries, right? That is the precise reason why it is called as an open economy. And when you have an open economy, foreign currencies will keep on flowing into your country. Foreign currencies will keep on flowing out of the country. Now understand this, in case of the foreign exchange reserves, who is the responsible party, who is given the duty of managing, keeping all of these particular foreign exchange reserves? The duty of maintaining the foreign exchange reserves has been allocated to RBI. Is it okay? Who will maintain the foreign exchange reserves or forex reserves? Right? The duty of managing the forex reserves is given to RBI. Done? Second important point. When I say forex reserves, what are its components? What are present in the forex reserves? Within the forex reserves, we have a basket of foreign currency assets. Okay, basket of foreign currency assets. That is the first one. What do you mean by this? You might be holding a dollar, you might be holding yuan, you might be holding foreign bonds, etc. Second, you will also have gold reserves. Okay, you will also have gold reserves within the forex reserves. Third, you will have special drawing rights, SDR, special drawing rights, or SDR. Now, what is this SDR? Give me a minute, I'll explain this. Fourth one, you will also have a reserve tranche. Okay, fourth one, you will also have reserve tranche at IMF. Now, third and fourth, let me elaborate on this. Both of them are associated with IMF, International Monetary Fund. Now, what is this reserve tranche and what is this special drawing rights? Let me start here. IMF is one of the global institutions. IMF was set up back in 1944 and it is one of the Bretton Woods institutions. Right? There were two institutions which were set up back in 1944. Right? That is one, IMF, International Monetary Fund, and the second one was International Bank for Reconstruction and Development, famously known as World Bank. Done. Now, have a look at this. Out of this, I am focused on IMF now. India is a founding member of IMF. Even today, India is a very important participant in the IMF. But the idea here is, whenever any member country or any country wants to become a member at IMF, is it okay? Whenever any country wants to apply and become a member of IMF like this, there is a concept of quota. Okay, there is a concept of quota. Again, how quota is calculated, etc. we'll discuss later under IMF. Please do not worry about it. There is the idea of a quota. That is, IMF says, I will decide a quota for you, and based on the quota, you will have to make certain contribution to IMF. Is it okay? You will have to give certain money to IMF in simple terms. You want to become a member? Okay, I will decide quota for you, and based on that, you will have to give me certain money. Done? Let's say hypothetically, as a result of the quota calculation, India has to pay $100 billion to IMF. I'm just taking an arbitrary number here. Okay, India has to pay $100 billion to IMF. Done? Now, when you become a member at IMF, IMF will give you certain reserve assets. Is it okay? Understand this very carefully. IMF will issue certain reserve assets to the member countries, and these reserve assets are called as special drawing rights, SDRs. Is okay? These are referred to as special drawing rights. Now, what is the special drawing rights? The reserve assets which are known as a special drawing rights are issued by IMF post 1969, and the value of this particular SDR is decided by IMF on day-to-day basis. I repeat, value of this particular SDR is decided by IMF. How it decides this? What are the currencies involved? We will discuss that later under IMF. Please do not worry about it. Just understand the basics here. Right, so India becomes a member country. All the member countries are issued a reserve asset by IMF, which are referred to as special drawing rights. And the special drawing rights which India has received from IMF are part of a forex reserves. Now, I stated that SDRs, okay, SDRs, right, the value of the SDRs are decided by IMF. What is the use of this? Imagine India is running short of the currencies. Okay, India is importing goods is importing services, is importing machinery, etc. So imagine a situation where India is running out of the dollars to pay for these particular machines. At this particular point of time, RBI will conduct the official reserve sale. Is it okay? RBI will conduct something called as official reserve sale, wherein it could simply sell these particular STRs and receive dollars. Is it okay? So these particular STRs are sold from one country to another country, right? IMF has a market for this. STRs can be sold from one country to another country. Imagine USA will purchase these particular STRs and in return will give us dollars. So the official reserve sale is conducted by RBI. The RBI will receive the dollars and use it to repay for the imports, to pay for the imports. That is why special drawing rights which are issued by IMF are considered as a part of the forex reserves. Next, what is the reserve tranche here? What do you mean by reserve tranche here? Go back to the original discussion here. India, to become a member of IMF, has contributed how much? Has contributed $100 billion to IMF. Now, IMF has a facility wherein 25% of the contribution done. Is it okay? 25% of the contribution that is done by India, or for that matter, any of these particular member countries, they can take it back. They can borrow it from IMF. Is it okay? I'll repeat it. The quota, right? As per the quota, how much is the contribution from India to IMF? 100 billion. But under the one of the lending facilities of IMF, this is called as a reserve tranche facility or basic lending facility. Under this particular facility, the member countries can take back up to 25% of the contribution of the quota that they have given to IMF without paying any charges to IMF. Very, very important. Without paying any charges to IMF. And no conditions will be imposed on this kind of a borrowing. That is generally when IMF gives a loan, it will impose certain conditions to the borrowers. No conditions can be imposed on the country which is taking this particular 25% back. Again, it has to repay it. But idea here is no rate of interest shall be paid, no service charges shall be paid by this particular country which is taking 25% from IMF, right? And no conditions shall be imposed by IMF on such borrowing by the country. This particular facility, wherein the member countries can take back up to 25% of their quotas from IMF, is called as a reserve tranche facility. Is okay? This is referred to as reserve tranche facility. And some of the books, they will confuse you by giving another statement. They will simply say reserve tranche is the difference between, follow this very carefully, it is confusing. Reserve tranche is the difference between the quota holding of a member country and how much is the actual holding of the member country at IMF. I'll repeat it. Reserve tranche refers to the difference between the quota holdings of a member country and the actual holdings of the member country at IMF. What do you mean by this? I stated that under reserve tranche facility, the member countries of IMF can basically take up to 25% of their quota contribution without paying any service charges. Let's take a simple example here. Government of India has contributed, what is the quota for Government of India under IMF? $100 billion. And 25% of this will be how much? $25 billion. So have a look at this. The quota contribution, quota holding should be how much? 100 billion. But because Government of India is allowed to take 25 billion right out of this without paying any service charges, at any point of time, if 25 billion is withdrawn, how much is there for, right? How much is the contribution now? How much is the holding of Government of India at IMF? $75 billion. So the difference between, right, the actual quota and the holding right now, difference is how much? $25 billion. And that is nothing but reserve tranche position at IMF. Is it okay? So it is also defined as the difference between the quota, which is the amount that the Government of India is supposed to hold there, and right, how much has been withdrawn and how much is left out. The difference between these two will give you the reserve tranche. So take the sum total of a basket of foreign currency assets, the gold, the special drawing rights, as well as the reserve tranche at IMF, you will get the forex reserves. Okay, and who is going to manage these particular forex reserves? It is the RBI which is going to manage these particular forex reserves. Now, what is the importance of these particular forex reserves? Why these are important? Please understand, the forex reserves will provide certain comfort to the market. It will provide certain comfort position to the market. What do you mean by this? Imagine India is continuously importing, and when you are importing, you will have to pay in universal currency, let's say dollars, and continuously dollars are flowing out of India. So, is it okay if I say that if that happens continuously, you will be exhausting your right the dollars? So, how much is the forex reserves? How much forex reserves you have will always provide certain comfort to the market. And using this only, they will calculate something called as import cover. Remember this also. Using this only, they will also calculate something called as import cover. What do you mean by import cover? Imagine a particular country has a forex reserves worth 100 billion and monthly it is importing, let's say 10 billion worth of imports. Is it okay? Total forex reserves is how much? 100 billions. and monthly they are importing $10 billion worth of the goods and services. So the import cover will be total forex reserves, that is $100 billion, divided by what is the value of monthly imports, $10 billion. So import cover will be 10 months. Essentially, it indicates that if I continue to import, right, if I continue to import monthly like this, the amount of forex reserves will be sufficient to pay for 10 months imports. Is it okay? I'll repeat it. If I continue to import it like this, the forex reserves that I have will be sufficient to pay for 10 months worth of imports. And the third very important point, whenever there are certain adverse events that are taking place in the economy, the RBI will be using this particular forex reserves, right, to stabilize the exchange rate. Is it okay? There are certain adverse events. Again, with respect to this, we'll discuss it under the exchange rate. Do not worry about it. Because if I start discussing now, first I will have to tell you what is exchange rate. Then only you will be able to connect it. What is the role of RBI? So let's not be worried about it. Just remember this. There are certain adverse events that are taking place in the economy, either because of internal factors, external factors, as a result of which there is a volatility in the forex market. RBI intervenes in the forex market, uses the forex reserves to stabilize the exchange rate. Done? And that is the precise reason the larger forex reserves you have, it will be considered to be a comfortable position. And in the context of India, if you have seen the newspapers very, very carefully, the forex reserves of India have kept on building. In 1991, they generally say that the forex reserves that we had at that particular point of time, it was just sufficient to pay for around 2 weeks of imports. We were about to exhaust all of our forex reserves. But over a period of time, we have kept on building huge amount of our forex reserves. At 1991, there was an issue with respect to BOP crisis. 2003, the forex reserves that were there with India crossed more than $100 billion. 2007, $200 billion. 2008 and 9, $300 billion. And today, we have more than $500, $600 billion worth of the forex reserves. And the larger forex reserves that you have, more comfortable position that you will provide to the economy like this. Done? So this is a discussion with respect to forex reserves. Again, in addition to this, you need to discuss, right, what is the role of RBI, how does it use this particular forex reserve. We'll have a discussion related to that later. But this is the point related to manager of a forex reserves. Next, important function of RBI, clearinghouse function. What do you mean by clearinghouse function? These particular banks are involved in different types of transactions. And RBI will mediate between these particular banks to settle these particular transactions. Let me give a very simple example here. Imagine you will receive a check, somebody has issued a check to you, and this particular check is of SBI Bank. Okay, the check has been issued to you, but this particular check is of SBI Bank. You do not have an account in the SBI. So what you will do? You will go to your bank. Let's assume Canara Bank. I'll write CB. Okay, Canara Bank. So you will deposit this particular check in the Canara Bank. Now, the SBI check has been deposited in the Canara Bank branch. So this particular transaction has to be settled. Let's say hypothetically the value of the check is 50,000 rupees, which essentially means the SBI account holder, right? The account holder in SBI has issued a check to you. You are supposed to receive 50,000 rupees from this particular bank. So the settlement of the transaction, the transfer of the funds from SBI to CB, right? The mediation will be done through RBI. So the bank transactions like this will be settled only after RBI mediation, or RBI will act as an intermediary between these particular banks to settle these kinds of transactions. Hence, right, RBI is referred to as a clearing house. Okay, RBI will also play the role of clearinghouse function. So these are the different functions of RBI. Very, very important. Please revise these particular functions as and when these are there in the newspaper. Please update these particular tools also. Done?